Hello and welcome to Scope's webinar today. My name is Barbara Claus and I'm a fund analyst at Scope and I will be your host today. Before we start the technical detail, you have the possibility to raise questions. So if you want to raise a question to the fund manager, please type them into the chat window on the right, either in English or in German, and we'll include your question during the webinar. So today's theme is emerging markets equities. Last year, this market segment has performed quite well, overall with 7.2% for the average fund in the Scope peer group. Although, when you take a closer look at emerging markets, there were significant performance differences between the different countries and region. For example, emerging Asia, especially China, was the main performance driver last year, while, for example, Latin America reported double-digit losses. So this seems like a good case for active managers that have the possibility to move away from benchmark and express their views freely. Today, we have such a manager here today. We have Xavier Hovasse from here, fund manager and team leader emerging markets for Latin America and the EMEA region. Xavier will speak with us about the strategy, positioning, performance, and of course, his outlook on emerging markets. While most of you might know Carmignac, I would like to touch on a few key points about the company. Carmignac is an independent French asset manager founded in 1998 by Edouard Carmignac and Eric Helderlé. The company is wholly owned by its employees, and it currently manages assets of around 37 billion in 23 investment strategies covering all major asset classes. Typical for the company is its active, conviction-based approach. Carmignac has 287 employees. There are 45 fund managers and analysts. Ever since it was founded, Carmignac has looked at emerging markets as part of its strategies and launched its first dedicated fund in 1997. So now I would like to start with the Q&A session with Xavier. So please remember you have the possibility to ask your question during the webinar. Just type them into the chat window. So hello, Javier. Good that we have you here today.
Bonjour, Barbara. Hello, everyone.
So I would like to start with the first question to you. Because as I said in the intro, Carmignac has looked at emerging markets ever since it was founded in the late 80s and manages an emerging markets equity fund in 1997. So how long have you been involved in this area and how have the markets evolved since then?
Well, you can see that I have gray hair. Sadly, I mean, the camera is of a high quality, so I cannot hide my gray hair. So I've been running emerging market strategies for quite a long time. I started 20 years ago in another company, and I joined Carmignac in 2008. So I've been with Carmignac for 13 years. But it's very interesting because the emerging market equity space has been completely transformed during these 20 years. I'm going to give you a couple of anecdotes. When I started emerging markets in 2001 with BNP Paribas in Paris, the largest country was South Africa. It was 14% of the index. China was 0% of the index. It was not even included in the benchmark. It was included, I think, in the early 2000s, a couple of years later. Today, South Africa is 2% of the index and China is 40% of the index, just to give you an idea of how things have changed. The largest companies when I started to work were Petrobras, Gazprom in Russia. When we woke up in the morning, the key question was, when you had the morning meeting in the team, so what happened to the Turkish lira this morning? So how have the Malaysian assets performed this year and stuff like that? Today, these things don't matter. I mean, Turkey is 0.3% of the universe, 0.3%. Alibaba, just one Chinese company, is 7%. So one Chinese company, Alibaba, is 20 times bigger than the entire Turkish market, just to give you an idea of how things have changed. There have been different phases in the year 2000. It was all about the commodity super cycle. This is when China was building its infrastructure. So prices of coal, iron ore, copper were going through the roof. And the main winners in the year 2000s were the South Africa, Brazilian real. Brazil was a fantastic market. Brazil was 19% of the index in 2009, I think, 19% of the index. Today it's 4%. So it was the commodity super cycle. And after that, you had the consumer boom. in the early 2010, between 2008 and 2015, it was all about, the rising middle class in emerging markets. So the best performing funds were the ones who had exposure to Ambev in Brazil, Walmex and FEMSA in Mexico, the Beam in Turkey, Magnet in Russia, and all these Indian and Chinese retailers as well. South Africa, you had ShopRite, which was a supermarket chain, and it was the consumable. This is when the commodity super cycle ended, mostly because China started to grow differently with less investments and a bit more consumption. Since 2015, in the last 6 years, it was all about tech. It was all about tech because, you've had the rise of the Tencent and Alibaba in China, Tencent being the Chinese equivalent of Facebook and WhatsApp, but with an ecosystem which is even more, even bigger than the Facebook. So Tencent's valuation went to almost $1 trillion. So with the recent sell-off, it's not only $800 million, but $800 billion. So it's one of the top 10 companies, half of Apple and Microsoft. But it could be the largest companies globally one day. So you had the rise of these companies, JD.com, Pinduoduo, Meituan in China. So the rule of the game was all about tech. So the best performing fund managers have been the one who understood the commodity, who played the commodity super cycle in the 2000, and then in the first half of the 2010 years was the people who understood, who were playing the consumer rise, and now it's been the tech thing. So this is how things have been evolving, and I've run through these cycles with Carmignac, trying to understand them, trying to value assets, trying to understand the main trends that were involved. So it was a thrilling journey, which and I think it's important to have in mind that the universe was completely transformed.
Thank you very much for that overview. Yes, it was like a really quick evolution in my view. In a bit more than 20 years, we moved on from a market driven by commodities, then over consumer stocks, and now they have developed pretty fast into the tech area, and China's share has grown a lot. So my next question is about you as a manager sitting in Europe. And maybe you have a view on the whole picture as an outsider. So I'm asking you, is this an advantage or a disadvantage in your view? And how do you generate your investment ideas? And have you cooperation, local cooperation for that?
It's a question that we are being asked constantly. You're an emerging market specialist, but you're based in Paris. Well, okay, fine. Where else should I be based? I mean, if I were based in São Paulo, I would be, closer to the Brazilian market, which is 4% of my index. If I were based in Moscow, I'd be closer to the Russian market, which is 2% of my index. No. So maybe I could be based in China. It's difficult to say. I think there is no general rule. Some emerging market boutiques have done really well with people locally based, and some emerging market funds like Carmignac have been doing really well with people in Paris and London. There's no general rule. What's very important to understand is that to identify key trends, like the one that I've mentioned before, it's very important to have a very good overview of what's happening. If you have too many local people, it's difficult to make some very important top-down calls. Let me give you a couple of examples. I invest 0% in South Africa. Carmignac Emergent has 0% exposure to South Africa, zero. It's been the case since I became the fund manager of the fund 6 years ago. To make this top-down call, it's easier if you're in Paris, sitting in Paris, rather than if you have someone based in Johannesburg who's going to be a South African specialist and who's going to come up with plenty of very good ideas. Same for Turkey. We've had 0% exposure to Turkey for the last 6 years. If you have a team of 3 people in Turkey coming every day with new ideas, so to make some very important top-down calls, it's really easier if you can have a very independent view. Well, and Also, we travel a lot. I mean, we all in the team, we travel a lot. I'm flying to China constantly. I mean, I've stopped, obviously, with the COVID-19, but we're traveling a lot. We have on the ground some consultants, some contacts who help us. We interact constantly with them. Voilà, so we still have some local ground. Haiyan, my Chinese co-PM, who's been a very good stock picker, has been very good in managing China. I mean, she's always in China, a week per month in average. She wakes up when she's in Paris. She makes a lot of calls with her Chinese contacts in the morning. So voilà, we still have interactions. So I don't know if it's an advantage or disadvantage. I would say for us, given that we have the ability to we are a very active fund manager. We don't try to replicate the index. So being away from the ground floor helps us to make some very important top-down calls.
So thanks for that answer, and I would suggest that we move over to the funds process. So I would like to ask you what your philosophy is and how you add value for your clients. Could you run us quickly through your investment process?
Sure. I have a couple of slides that I wanted to show you on that. So hang on. Let me find the arrow. Yeah, so this is basically the history of Carmignac, for your first question, the history of Carmignac and the funds that have been launched, Carmignac Emerging being the main flagship fund. On the process, it's difficult the process has somehow evolved, and I'm going to tell you how, but the kind of compass, it's not that it's changed, that it's the process has been adapting to the new situation, all these changes, structural changes that I've mentioned earlier. There are three things that we need to do as a fund manager. We need to pick the right country, we need to pick the right sector, and we need to pick the right stocks. Sounds like an easy job, but for that you need a compass. On country selection, we want obviously to invest in countries which have strong macro fundamentals. And what that means is, for us, is surplus in the balance of payments. You have two categories of countries, the ones which have sizable deficits and the ones which have sizable surpluses. If a country has a deficit, it needs that, the implication is that it needs external funding. It needs capital from the rest of the world to finance its domestic economy. And when you have a surplus, it's the other way around. And when you have a surplus, the implication is that the economic agents, so the households, corporates, and government combined, are generating more savings than investments. So the economy is perfectly self-funded. So we want surplus in balance of payments. That's why we have always favored North Asia, so Korea, Taiwan, and China, which have always displayed some sizable current account surpluses. And we have avoided some of the countries which I've mentioned before, South Africa, Turkey, Brazil, until recently was a country where we had very little investments, very small investments there. I mean, we've increased Brazil recently, but generally speaking, in the last decade, we've been massively underweight Brazil with very small exposure there, and Latin America as a whole, because of the deficit. So we want to deploy capital preferably in countries which have surpluses in their balance of payment. North Asia being where you have the best fundamentals. For sectors, we invest preferably in sectors which are under-penetrated. Like I say to my investor base, if you are thinking of deploying capital to emerging markets, equities, there is more risk. It's very volatile, there's more country risk, political risk, you need to worry about currency risk, all these things, the trade tensions between the US and China, which is the next country that Putin is going to invade, all these things are problematic. So why would you even bother investing in emerging market equities? And the answer to that is that in emerging markets, you have a lot of under-penetration. You can buy a bank in a country where half of the population doesn't have a bank account. So you have a 10, 15, 20 years of growth ahead of you. You can buy an insurance company in a country where insurance penetration is very low. So you can buy a bank in Mexico, an insurance company in China. You can buy a car company in India, for example, where car ownership per capita is very low. So you have under-penetration. So I've mentioned countries, I've mentioned sectors, a few words on stocks. Stock selection is key. It's different. I mean, there's not a very easy rule to know how to find a good stock. Obviously, it's a lot of work. It's 90% of our job is to try to understand, businesses of companies, the regulatory environment, the competitive environment, all these things. But the compass that we're using is mostly, I would say, good cash flow profile. We like companies which have a good cash flow profile. We don't like airlines, oil companies, mining companies, construction companies. We don't like companies with a lot of capital intensity. We like companies that can have the ability to self-finance their growth, which is like why we like internet companies, insurance companies, some retailers as well. Companies which have the ability to self-finance their growth. So this is basically the investment process. A 30-second summary of our investment process for anyone who just wants to to understand easily the process. We deploy capital most preferably in countries which have strong macro fundamentals, which we define as countries with surpluses in their balance of payment, in sectors which are underpenetrated and offer proper long-term growth story, and in companies which have a good cash flow profile that will allow them to self-finance their growth. Voilà. This is the investment philosophy. And there's also an ESG aspect to that, which we can discuss later on if you want.
Yes, sure. This was also an aspect I would like to touch on Carmignac's SRI approach. So where do you place the emphasis within your SRI approach? And do you avoid certain regions or sectors due to SRI reasons? Could you please also give us a few examples?
Alors, before I answer that question, just a quick comment on SRI, ESG. It's very important for everyone. People understand how important it is, and have more and more questions from my investor base. Carmignac Emergent was the first fund at Carmignac to have the label, the ESG label from the French government. We also have a second label from the Belgian government today, but we were at the forefront of the ESG revolution within Carmignac. And the main reason for that is that ESG is obviously very important in developed markets, but it is even much more important for emerging markets than developed markets, much more. Why? Take the three, E, S, and G. Environment. Where have you seen the biggest environmental issues globally in the last decade? The answer is in emerging markets. Like the Macondo issue in Mexico, or the Valley disaster that we had a couple of years ago, 2 or 3 years ago. In emerging markets, the environmental considerations are more important. That's where you have most of the mining activity as well. In China, particularly, you have a lot of issues. So the E part is obviously more important for emerging markets. S, the S part of ESG. S is social. In emerging markets, people are poor. They are sometimes starving to death in many countries. So any problematic social issue has a much bigger impact. Like in Germany or in France, if there are social issues, it does not result in people dying of starvation. It doesn't resolve in in the same social. The social implications are not as important as in emerging markets. So that's very important. And same for G, governance. There are a lot more companies which are governed by crooks, which have a horrible corporate governance. In some countries like Russia, I hope there are not too many Russian people listening to this conversation. They don't like. Actually, usually they agree when I say that. But in Russia, a lot of companies are totally uninvestable. Although I have to admit that it's been much better. There's been a significant improvement in the last few years. But they are state-owned companies run by oligarchs, which are being nominated by Putin. It's not, it's not really how governance should be. There's been a lot of accounting issues in China, and a lot of problems also in Brazil with the Lava Jato, the big anti-corruption investigation scheme. So it's more important in emerging markets than everywhere else. That's why we've always have we've always done a lot of work. So what we do is a detailed ESG analysis for every single investment. You can see on this slide here, detailed ESG analysis for every single investment that we have in the fund based on trajectory, best efforts approach. I mean, a company where the starting point is not amazing, but where there's a lot of improvement is going to be rated much better. We have our own exclusions. We exclude at least 20% of the universe by our own work, doing stock by stock. We also have a lot of engagement with the companies that we own. We vote 100% of the time, and we try to improve things as well. So you can see also that coming back to the investment process here at the top, which I've mentioned before, when I said, remember when I said we invest in under-penetrated sectors, this already has a sustainable part embedded in the process, because when you invest in under-penetrated sectors, obviously there is a sustainability aspect. And if you look at the fund today, the way it looks, you can see that when I mentioned to you, we were buying banks in countries where banking penetration is low. This is banks in LATAM, banks in India, insurance companies in India and China. Somebody's going to take my temperature, so don't worry. This is the COVID-19 process. It's not like someone putting a gun on my head. So it's under penetration. When you buy a bank in these countries, they are financing the future. We're not buying banks in China where there's too much credit. When there's opacity, we're buying banks which are lending to people who are taking their first loans, households who are taking their first mortgage, companies who are taking their first working capital loan. So it's really, sustainability is already embedded in here. Same when we talk about innovative technologies. LG Chem, which is the manufacturer of EV batteries. We have a lot of exposure to the EV space. A lot of fintech companies also doing financial inclusion, and also under penetration goes hand in hand with improving living standards. So a lot of healthcare exposure in Brazil and China, particularly, and so sustainability is embedded in our investment process.
Okay, thank you very much, Xavier, for providing us this overview. For the audience, I just would like to sum up quickly the key points of the process and your ESG process. So the process at Carmignac is very active, and it's driven by top-down considerations as well as bottom-up stock selection. So top-down, they look at the country, and there is a preference for countries with an account surplus. And also they look top-down for sectors that are interested, and here they look for sectors where they have an under-penetration for the services or products they provide. Like he said, for example, in insurance, there's a lot of catch-up to do, but also in healthcare in Latin America. So they also look on the sector basis. But most important is the individual stock, the stock picking, and there they really look for companies that benefit from those drivers, and that they have the possibility to grow without having too large asset base. So there is a preference for companies that have the possibility to grow without having these asset base weighting them down. So there's a preference for sectors like healthcare, technology, insurance sector, for example. And ESG is a very important point, because Xavier says that ESG is even more important in emerging markets, because they have usually lower social standards, for example, or also not a good governance. He mentioned Russia, for example, but also fraud, like we had in China with Luckin Coffee more recently. So there's a lot to do on the ESG field. So it's good to have a filter in there, also to avoid not only companies doing harm, but also avoid drawdowns in stock price. So it was my little summary. Thank you so much for that. Thank you so much. So the next thing I would like to move on, I hand back to Xavier now. And I wanted to point out performance, because you achieved a stellar performance last year with 45%, being a multiple of the peer average of 7.2%. So I'm really curious, what were the drivers for this, and how much was driven for example, by the pandemic or company fundamentals or sector?
Alors, I will tell you a little bit more about the performance. So let me. Sorry, I forgot. I wanted to show you a slide. I'll come back on performance, but I forgot to show you a slide. I'm very proud of this slide. Is that we have a very good carbon footprint. This was on ESG. Carmignac Emergence carbon footprint is much better than the index, and even better than the low carbon target index from MSCI. Well, I forgot to mention it, but I think it's important. On performance, I have a lot of questions on performance. Before I answer with details, I'm going to give you a big overview. I think the number one thing to understand is, at the beginning I said, in the last 6 years, the name of the game was tech. And a lot of investors have been questioning this tech rally. Is it a bubble? I remember even my own investors were telling me, Tencent, it's a bubble. It's worth $100 billion. That's what I was hearing in 2016. And then in 2017, suddenly it was worth $400 billion. It's a bubble again. And then $600 billion. And then $800 billion today. So I think one of the key things that Carmignac did well, not only my team, but Carmignac as a whole in the equity team, is we understood it was not a bubble. We are living an industrial revolution. This digital revolution is an industrial revolution, which is similar. There's one per century. So what we are living, and why am I saying that? Because this digital revolution is affecting our lives from A to Z. Everything that we are doing today is being done differently, as evidenced, by the way, by this format that we're doing today, which is very, very efficient. I can speak to tens or hundreds of investors at the same time. I can interact with Barbara. We can show slides. It's very efficient. We work differently, a lot more from home, by the way, hopefully. We are interacting with other people differently. School is also being transformed. I can see that with my children. They are going to use more and more tech. We consume differently. We buy stuff differently. We feed ourselves differently. Everything is being transformed. So this is an industrial revolution. And when you have an industrial revolution, the question is more like, is it a disruptor or is it a disruptee when you buy a company? So when I started to work in emerging markets, it was all about the country risk. I'm not saying that there's no country risk today that needs to be analyzed. And we saw with Argentina blowing up that if you buy a bank in Argentina, you lose all your money. But in reality, take the example of Mercado Libre. Mercado Libre, which we bought in 2014. Mercado Libre, when we bought in 2014, for those who don't know Mercado Libre, it's the Alibaba of Latin America. When we bought it in 2014, the three main top countries of Mercado Libre were Brazil, Argentina, and Venezuela. Brazil, Argentina, and Venezuela have been basically the three worst countries in terms of macro since 2014. It's difficult to do. Maybe Lebanon has done worse, but it's very difficult to do worse than these three countries. When we bought Mercado Libre, it was worth $4 billion. Today, it's worth $70 billion. 70. So it's been more than a 15-bagger. So this tells you that we are living in an industrial revolution, and if you understand that, you can make money in any country. And we've understood that at Carmignac. So every time we avoided banks, and we favored fintech. We bought the best, all the winners, direct and indirect winners of the Industrial Revolution. So the direct winners are going to be the Mercado Libre, the JD.com. You can see here on the next slide the best contributors to last year's performance. You can see C Limited is the Alibaba of Southeast Asia. It was up 355%. Obviously, it was a large position in the fund. It was a 4% position in the fund at the start of the year. Mercado Libre was up 172% when the MSCI LATAM was down 25%. JD.com was up 130%. JD.com is the Amazon of China. They are the competitor of Alibaba, but we prefer JD.com. Voilà. These are the direct winners of the Industrial Revolution. We also bought the indirect winners like Samsung, TSMC, which are the manufacturers of DRAM, and so of semiconductors. The industrial revolution that we are living needs more semiconductors, especially with the coming years. So what we've seen recently is in the last 5 years was the e-commerce and all interaction, social network. But now in the next 5 years, there's going to be you're going to have the Internet of Things, which is coming, and after that, you're going to have the autonomous cars. All these things require more semiconductors, which are manufactured in Asia mostly. Indirect winners of the Industrial Revolution, the cloud businesses, the data centers companies, which we owned last year. The biotech and healthcare companies, which we bought last year, did really well as well. And there's another industrial revolution. So that's what we're seeing today is a very weird situation. We have two industrial revolutions happening at the same time. Normally you have one per century. History is accelerating. And today we are living two industrial revolutions. The first one is the digital revolution. The second one is the green revolution. And with the Biden administration, we're going to see another round of acceleration. The green revolution, it's kind of counterintuitive, but the number one country in the world is China. This is the country which invests the highest share of its GDP in clean energy to try to improve pollution and improve its energy mix. China, but also Korea is doing a lot of efforts. Germany, I mean, you guys know better than me. Europe is doing a lot of efforts. And now the US, I mean, Trump was kind of a climate issue denies. He left the Paris Agreement. He said, it's a Democrat hoax. Global warming is a hoax. But now you have an administration that is going to focus a lot on the green revolution. Last year, the green play on the green revolution performed really well. So we had NIO, which is the Chinese Tesla. We sold it because the valuation went too high. But last year we bought it in June, and we made a lot of money here. LG Chem, the Korean battery manufacturer, which is also very well positioned on the green technology. So these two things helped us last year. I can say that I would have no problem admitting that the COVID-19 has been helpful to the performance. I mean, it's a very sad thing. It's been disastrous, but for the performance of Carmignac Emergent, it's helped. Why? Because it has accelerated the industrial revolution, the digital industrial revolution. And I believe personally that life will never come back as it was before, pre-COVID-19, because we now realize that we can live differently and efficiently. So I think it's irreversible, but it accelerated the industrial revolution. One very funny number to explain that is that it took 10 years in the United States for e-commerce to grow from 5% to 15% of consumption, 10 years. And when you had the lockdown last year in the US in April, it took 10 weeks for e-commerce to move from 15 to 25% of consumption. So in 10 weeks, you saw the same progression than in the previous 10 years. So it's an acceleration of history. In the case of the other industrial revolution, which is the green revolution, to be very honest, I think it's a coincidence if it performed very well last year, because in reality, the green revolution should perform better when the price of energy goes up, because that's where the economics of alternative energy improve. Last year, the price of oil went down, so you would expect normally the green names to underperform, and they perform nonetheless, which I think can be explained by one thing, which is probably, I would say, the regulatory framework, which forced a lot of investors to have an interest in the green thematics. But also, I would say, out of a coincidence, a lot of interest from retail investors happened at the same time. So that's why last year they performed very well. Also, I would say that the European plan to boost the economy also has a lot of positive implication for the green revolution, because a lot of the investments are going to be directed towards the green theme as well. So I would say that indirectly, the green theme performed very well last year. But on performance, Barbara, let me add one more thing. Mm-hmm. You mentioned the good performance last year, but this is the 5-year performance. You can see in red here. Looking at Carmignac Emergent returns, information ratio, Sharpe ratio, all these ratios, max drawdown, Sortino, Kalmar ratio, all of them are telling you that Carmignac & Gewinnern has done well over the long term. It's not only a 2020 event. I have to admit that 2020 was has been very, very helpful, but over a 5-year period, you can see that the metrics look really good for Carmignac & Gewinnern. It's not only last year.
So thank you very much for showing us the details of your performance. So as you said, the themes have done very well, and they would have done so, but maybe would have taken longer time unless the pandemic arrived and were a huge driver. So we can also see in your examples here that it is very helpful or rewarding to be active when you select the right stocks, because the divergence we have seen in single countries or markets are pretty high. For example, Mercado Libre in Latin America, a region which has done very, very poorly, but that stock is up over 150%. That's impressive, but you have to pick it in advance, and that has worked very well. So, so a good overview. And now I would like to ask you if you could speak a little bit about your current view on markets and sectors and how you have positioned your portfolio. For example, do you still think that there is a lot of future growth in some areas, or are some already pretty pricey because of this dynamic that acted as a price catalyst, and many shares, they have two-folded, three-folded, four-folded already? What's your view on that?
It's a case-by-case situation. So I have put together a few slides on our current position. It's a case-by-case situation. We had to sell to zero some of the biggest winners of last year, which is always a difficult thing to do when you're a fund manager, because you have a stock, it works very, very well, you like it, and you're very happy, but you have to be disciplined and sell them to zero. So NIO is the best example of what we've been doing here. NIO, like the Chinese Tesla, but also some of the Chinese healthcare names, which we had bought years ago, and of course with the pandemic last year, they went through the roof, and we trimmed them. Sometimes we sold 2/3 of the position, and sometimes we sold the entire position. So we had to rebalance a bit and to buy more of the names that are more cyclical and more value, to rebalance the fund in the case of a big rotation for 2021 rotation, which by the way is happening this year. So it's a case-by-case situation. Having said that, the fund still, we don't want to compromise our investment process, and we don't want to buy Gazprom in Russia, PetroChina, Petrobras, and these guys. So we still believe that over the long term, we need to buy the good compounders, the winners of the Industrial Revolution, the companies which have good long-term growth prospects. So the fund is still heavily positioned in the same, in the core thematics that we've liked in the last few years. You can see that we still have 83% of Asia today. We still have in the top 10 position mostly Asian companies. LATAM is only 11%, and EMEA. These numbers are for end of February. Now Russia is a bit bigger because we've been buying Russia, so we have probably 8% of Russia today. So we rebalance the fund, and we've been buying a bit of Brazil, which hasn't worked. It's been a big mistake. Brazil hasn't worked, mostly for political reasons, but also because they were hurt by the new strain in Brazil. They have a new strain, which means that they had to lock down again a lot of large cities like São Paulo, and they have Bolsonaro is going to have to spend more. So the real is under pressure, and then you have some political issues and stuff like that. So that was a mistake. We thought that Brazil's balance of payments had become stronger last year. For the first time since 2006, Brazil had a current account surplus after the large depreciation of the currency. We saw last year the real lost 25%, but Brazil exports mostly iron ore, soy, corn, meat, and oil, and the commodities that are exported by Brazil saw price going up with the real going down. So we believe, and that generated a current account surplus. So we believe that it was a good way to go there. It was a good moment to invest in Brazil. We've invested in Russia, which has been working much better because Russia is a big beneficiary of the rebalancing. A lot of the Russian companies are value companies. Oil is going up. I don't know if you saw, but OPEC last week has decided to cut production, and Russia was the big winner because Russia was allowed to increase production. There has the sanctions against Russia after the Navalny imprisonment from both the European Union and the US were very mild, so they're not going to affect Russia at all. So Russia is doing really well. And there are a few very good companies. Yandex, which is the Google equivalent of Russia, the Moscow Exchange, which is very good. And also we bought recently, last week, a new company called Fixed Price, which is a hard discounter, a retailer hard discount. Voilà, so we've rebalanced a little bit, but the core of the portfolio is still in Asia, where you have the big surpluses, when you have the best winners, the big winners of the Industrial Revolution. Samsung, our largest position, is a company with $100 billion of cash on its balance sheet. Very high margin in its core business, which is DRAM manufacturing, the memory used for semiconductors. They have 40% EBITDA margin, going to 50%. So it's a very, very solid business. Same for JD.com, which we still like a lot. Very profitable company. So our largest position have all net cash balance sheet and a very profitable business. The top 4 positions have a net cash balance sheet and a profitable business, but are still mostly Asia. And the thematics are, again, e-commerce, internet, green tech leaders, cloud companies, data centers, and some healthcare, consumption upgrade, financial inclusion, education, China East education. So we're still heavily invested in the core thematics that have been in the fund in the last few years. We haven't reshuffled the portfolio. We've just rebalanced a bit, adding to Hyundai, Samsung, which are more value names, and adding to Russia and a bit in Brazil. But we don't want to compromise an investment process just to play a kind of rotation trade for this year.
Mm-hmm. Okay, thank you very much for guiding us through your portfolio. One question that I have in my mind is performance. I wanted to ask you, so after the good performance of emerging markets, especially your fund in 2020, what can investors expect from those markets going forward? And do you think emerging markets can achieve similar performance in this year and beyond?
Alors, it's funny because what people don't have in mind is that over the last decade, emerging market equities have underperformed dramatically developed markets. And I have a slide proving this. Yeah, this is emerging market equities versus developed market equities. This is the huge underperformance of emerging market equities. And last year, in your introduction, Barbara, you mentioned that emerging market equities did well. Fine, it's true. But in reality, emerging market equities outperformed last year developed market equities by only 1.5%. And this year, they're performing in line or 1% better. So it's absolutely nothing after this decade of significant prolonged underperformance. So there's a lot of room for emerging market equities to outperform, especially as it's very obvious now to everyone that Asia is doing much better than developed markets, not only in the pandemic, in the way they managed the pandemic, but also because the US is being managed like a banana republic. I mean, they are sending checks to the population. The fiscal deficit in the US this year is going to be the size of the Russian GDP. The trade deficit of the US is going to be the size of the Turkish GDP. And the balance sheet expansion at the Fed is going to be the size of the UK GDP. So they are saying, okay, fine, we want growth at any price. They're not even investing intelligently. At least the European Union is doing the same thing, but at least they are trying to direct investments to good, sustainable sectors. Like China. China is doing that when they do a fiscal plan to boost the economy. They're investing in the right sectors. The US, they're sending checks to the population. What are they doing? They're buying Tesla shares and they're buying Chinese manufactured products. So you're going to have, last year, you had the worst trade deficit between China and the US in the history of the two countries, which, by the way, acts the fact that Trump failed in its attempt to reduce the bilateral deficit between China and the US. Biden is doing the same thing this year. You would expect, and I don't know why. I'm not an expert in the US politics, but Schumer sounded like a more balanced person, but the head of the Senate guy. But he's scared to have AOC running against him in New York next year in the for the Senate election, because his seat is at stake next year in November. So the pressure from the left part of the Democrat worked, and they are expanding the fiscal help, and the Americans are going to receive a check again in a few weeks. So this is not what I call good policies, when in Asia they have very good policies. So all this is very positive for emerging markets, because you have more dollars circulating. It's going to be bearish dollar. The dollar's been strong for the last 3 weeks, but the dollar is going to have a bearish cycle, given the Fed expansion and the fiscal expansion, particularly against Asian currencies. But this is positive for emerging markets as a whole. So we are still positive. Look at this chart here. You can see fiscal stimulus packages as a percentage of GDP last year, Asia versus developed markets. You can see that Asia has been much better managed. So Asia had a better growth, but it not only had a better growth, it had a better quality of growth last year. So the macro fundamentals of Asia have improved significantly in comparison with the developed markets. I don't know if you're aware of that, but China last year had 2.5% real GDP. Sorry, had 2.5% real rates on the 10-year bonds, while the US were at -1. There was no monetary stimulus, a very subdued fiscal stimulus, and despite that, China had 2% growth versus the US at -4. So the renminbi was appreciated last year, was the strongest currency globally last year. It's again this year one of the strongest currencies globally, but I think it reflects the improvement in fundamentals, and you can see here the change in Fed balance sheet. This is obviously very bearish dollar and very bullish for emerging markets. Voilà. So I think we still have Carmignac has a bullish outlook for next year.
Thank you for providing us your outlook. And related to that, I have a question from the audience. A participant asks what the main risks to your EM scenario is, and how these countries do manage increasing debt at a time while the developed markets, as we have seen already in your chart, are also highly indebted.
There are some individual countries which can blow up. Brazil can blow up, Turkey can always blow up, South Africa will blow up. Maybe not this year, but for the following year, I don't know when they will blow up. But they are small pockets of emerging market equities. That's the key thing to understand. Like, emerging market equities today is 80% Asia, and mostly China, Korea, and Taiwan. These countries are not going to blow up, and they are generating more savings than investment. So people say there's a lot of debt. For example, in China, it's true that the corporate debt market, the credit market in China is big, but the savings generated in the domestic economy are much bigger than that because of the current account surplus, as reflected by the current account surplus. This is pure math. So they don't need external funding. Chinese debt is financed by Chinese investors. That's the key thing to understand. It's a situation comparable to Japan. Japan has a lot of debt. Doesn't matter, because the Japanese own their own debt. They finance their own economy. So I think that the big risk does not come from debt. There are some pockets of debt in China of credit which are at risk, like in the construction sector, which is very cyclical always. But if there's an issue, the large Chinese banks are very liquid, very well capitalized, and they are state-owned. It's the Chinese government in the end. And the Chinese government is healthy, much healthier than any European country. We need to be careful. I mentioned Russia before because we deploy a lot of capital in Russia. I try to guess, Barbara, the debt to GDP of Russia when they entered the COVID-19 crisis last year.
Guess
the debt to GDP.
It really depends on the oil price. I've heard like 70%, I would guess.
No, it was 11%.
Oh, okay.
So because Putin has been running very conservatively his economy, so they had a 3% fiscal deficit. So it used to be 70%, you're right, but it's collapsed. And after the Ukrainian war, he said, okay, I'm not having any funding from external sources. So he decreased debt to GDP. So when France started entered the COVID-19 crisis with 99% debt to GDP, Germany in the 70s, if I'm not mistaken, Russia had 11% debt to GDP, 11%, and going down because Putin balances his budget with oil price at $40. So it's a case-by-case situation. There's a debt problem you can argue, in South Africa, in Brazil, in some pockets of the Chinese credit market. But overall, the current account situation of emerging markets is positive, which means that they are generating more savings. A lot of these countries they are financing the debt of the Americans. It's not the other way around. So if anyone needs to worry about debt, it's probably in the developed markets more than in the main Asian equity markets.
So thank you very much, Xavier, for your summary and touching on your outlook and also where you see the threats to the emerging markets. I found it very interesting, and I'm taking with me a lot of things. For example, that not only the fundamentals for most countries, and especially the largest area of emerging markets, Asia, which is dominating with 80% by now, are in favor, but also regarding the price difference between, or the share price valuation difference between emerging markets and developed markets is still high, and there's still a lot of catch-up to do. So these were the key takeaways from me, but of course you have to be selective and avoid the traps and look out for the right countries, sectors, and stocks. So that's why we close that circle. That's why an active, unconstrained approach, high conviction approach pays out. So that was it from me. And I think we are at the end of the webinar. So I would thank you all. Thank you very much, Xavier, for answering all our questions and giving us a deep insight into what's going on in the emerging markets and how they have developed. So thanks for being here today.
Thank you very much, Barbara. And I apologize for not speaking German because my parents speak Spanish for me at school, so I don't know anything in German. So I'm sorry. I'm very happy, and I'll come back if you re-invite me with a lot of pleasure. Thank you very much.
Yeah, thank you. Would be great if you could give us an overview in the future again. And it's a problem because we all speak English, or we all should speak English in Germany and also in France, which is really good. So we have one common language. And yeah, so also thanks to the audience for being here today. I hope you found it as interesting as I did. And I wish you all a good day. And I hope I see you at one of our next Scope webinars. Thank you and goodbye.
Merci.